real estate, or stocks? It's one of the biggest financial decisions millions of Americans will ever make. Some people swear rental properties are the fastest path to wealth. Others believe the stock market beats everything over time. But what if both sides are leaving out part of the story? Today, we're putting both investments through the exact same 20-year test. Same starting money, same economy, same timeline. And by the end, you'll know which investment made more money, which one demanded more sacrifices, and why the answer isn't what most people expect. I'm Gavin, and on this channel, we break down money, investing, and wealth using real numbers, not opinions. For more this type videos, consider subscribing and liking. Let's get into it. 2 investors. 1 decision. Meet Ryan and Alex. They're about the same age. They earn similar salaries, and after years of saving, they've both reached the same milestone, $100,000. From this point on, their financial futures depend on one decision. Ryan chooses real estate. To him, wealth is something tangible, a house he can walk through, a front door he can unlock, an investment he can point to and proudly say, "I own that." So he uses his $100,000 as a 20% down payment on a $500,000 rental property. The bank finances the rest. Alex makes the opposite choice. He doesn't want tenants. He doesn't want another mortgage. He wants to own businesses without having to run them. So he invests the same $100,000 into a low-cost S&P 500 index fund. Then he turns on automatic investing, closes the app, and lets time take over. At first glance, the winner seems obvious. Ryan owns a $500,000 property. Alex owns numbers on a screen. If you asked most people who made the smarter decision, they'd probably choose Ryan. And honestly, so would most new investors. But first impressions don't always survive 20 years. Why real estate looks like the winner. For a while, everything goes exactly the way Ryan hoped. On the first of every month, rent lands in his bank account. Part of it helps cover the mortgage, and every payment builds a little more ownership in the property. Then something even better happens. The housing market starts climbing. Ryan checks what similar homes in his neighborhood are selling for, and they're worth more than when he bought his. Without renovating the kitchen, without painting a single wall, his investment has already increased in value. That's the power of appreciation. But appreciation isn't what makes real estate so powerful. The leverage is. Ryan didn't need $500,000 to control a $500,000 property. He only needed $100,000. The bank financed the rest. As long as the property's value keeps rising, Ryan benefits from the growth of the entire asset, not just the money he invested. And the advantages don't stop there. His tenants are helping pay down the mortgage. He's building equity. And many real estate investors can also benefit from tax deductions such as mortgage interest, depreciation, and certain operating expenses. It's easy to see why so many Americans believe real estate is the ultimate wealth-building strategy. At this point, Ryan isn't second-guessing his decision. If anything, he wishes he'd bought the property sooner, but every investment has a side. That looks much better from a distance. The hidden cost nobody talks about. Every investment has a honeymoon phase. For Ryan, it ends with one phone call. His tenant's water heater has failed. A few hours later, the repair bill lands in his inbox. Just like that, months of rental profit disappear. And that's when Ryan realizes something. The rent check isn't profit, it's where the math begins. Because every month, there's another expense waiting. Property taxes, insurance, routine maintenance, and the unexpected repairs that never seem to happen at the right time. That's why many experienced investors set aside 1% to 2% of a property's value every year just for maintenance and future repairs. Then comes something every landlord eventually faces. Vacancy. One tenant moves out. The rent stops immediately, but the mortgage doesn't. Neither do the taxes or the insurance. Before Ryan earns another rent check, he has to clean the property, advertise it, schedule showings, and hope the next tenant is just as reliable as the last one. And then there's the one expense almost nobody includes in the spreadsheet: time. Every repair, every contractor, every lease renewal, every unexpected phone call. Even hiring a property manager reduces your workload, but it also reduces your cash flow through management fees. That's why experienced investors often say, real estate isn't passive income, it's a business. By now, Ryan is still building wealth, but he's also investing something else, his weekends. At this point, you'd probably expect Alex to be way ahead, but that's where this story gets interesting. The investment that feels too boring. While Ryan is busy managing his property, Alex is doing almost nothing. Every month, his investment happens automatically. No tenants, no repair bills, no late-night phone calls. Most days, he doesn't even open his investment app. And that's exactly why so many people underestimate the stock market. Because it doesn't feel like wealth. There's no house to show your friends, no keys in your pocket, no monthly rent hitting your account. Just numbers, quietly moving up and down. Sometimes those numbers rise, sometimes they fall hard. There are days when Alex opens his portfolio and thousands of dollars have disappeared. Nothing changed about the companies he owns, only the price people were willing to pay for them. That's why successful investing isn't about predicting the market, it's about surviving it. So Alex ignores the headlines. He keeps investing, month after month, year after year. Slowly, something begins to change. His early returns start earning returns of their own. Then those returns begin creating even more returns. That's compounding. And over long periods, broad U.S. stock indexes have historically grown through exactly this process, even after major market crashes. Ryan can see his investment growing. Alex can't. Not yet. But after 10 years, the numbers finally tell the story. The 10-year scoreboard. 10 years have passed. A decade of investing. A decade of believing each of them made the smarter choice. Now, it's finally time to compare the numbers. So, who's winning? Most people expect Ryan to be comfortably ahead. After all, he owns a valuable property. His tenants have helped pay down the mortgage, and years of appreciation have increased his equity. Under assumptions similar to our example, a $500,000 rental property purchased with a 20% down payment can build substantial equity over a decade through appreciation and mortgage paydown. Although actual results depend on financing, expenses, and local market performance. But Alex hasn't stood still either. While Ryan managed one property, Alex quietly kept buying more shares, month after month, year after year, without trying to predict the market or chase the next hot investment. And here's the surprise. After 10 years, the scoreboard is almost tied. Ryan's leverage accelerated his returns. Alex's compounding quietly caught up. Two completely different strategies, yet remarkably similar results. And that's when you realize something. The real difference was never just the money. It was what each investor had to give in return. Ryan spent 10 years working on his investment. Alex spent 10 years letting his investment work for him. Neither path was easy. They were simply difficult, in different ways. And over the next 10 years, that difference becomes even more important. The part nobody calculates. By now, it's clear that both investments can build wealth. But money wasn't the biggest difference between Ryan and Alex. Time was. Ryan's rental property made him wealthier, but it also made him busier. Every repair, every lease renewal, every contractor, every unexpected phone call. Even with a property manager, major decisions still fall on the owner, and management fees reduce rental income. Alex faced a different challenge. He had to trust a process he couldn't control. He couldn't renovate his investment. He couldn't speed up its growth. His biggest job was having the patience to do nothing. Then there's something else most people never consider. Liquidity. Imagine both investors suddenly need $50,000. Alex can sell part of his portfolio in minutes. Ryan can't sell half a house. His money is locked inside the property unless he refinances, borrows against it, or sells it altogether. Then there's diversification. Ryan's future depends heavily on one property, in one neighborhood. Alex owns small pieces of hundreds of companies through a broad index fund. If one company struggles, his entire portfolio doesn't. Neither approach is perfect. One gives you leverage, the other gives you flexibility. One asks for more involvement, the other asks for more patience, and that's when you realize something. The real question was never, which investment makes more money? It was, which investment fits the life you want to live? Because over the next 10 years, that answer changes everything. The 20-year reveal. Another 10 years pass. 20 years since Ryan and Alex made one decision. That changed their financial future. Now, the experiment is over. Ryan looks at his rental property. The mortgage balance is dramatically lower. The home is worth far more than when he bought it. Years of appreciation, combined with years of mortgage payments, have built substantial equity. Under assumptions similar to our example, a $500,000 rental property purchased with a 20% down payment can build significant equity over 2 decades. Although the exact outcome depends on appreciation, financing costs, expenses, and local market conditions. Alex's journey couldn't have looked more different. No tenants, no renovations, no emergency phone calls. Just one simple habit: investing every month and letting time do the rest. Over the years, his returns began earning returns of their own. Then those returns created even more returns. That's the quiet power of compounding. Not because it works fast, but because it never stops. Over long periods, broad U.S. stock indexes have historically built wealth through compounding, despite major market downturns along the way. Now, the final scoreboard is complete. And here's what surprises most people. Neither investment completely crushed the other. Ryan built wealth through leverage. Alex built wealth through consistency. Different strategies, different lifestyles. Yet after 20 years, both ended up with impressive wealth. But then, one small decision changes the math. Imagine Alex increased his automatic investment by just $200 a month. No riskier investments, no stock picking, no perfect timing. Just one slightly larger monthly contribution. Over 20 years, that simple habit could add hundreds of thousands of dollars to his final portfolio, because every additional dollar has decades to compound. And that's the twist. The biggest difference often doesn't come from finding a better investment. It comes from investing more consistently, for longer. The real winner. So, after 20 years, who actually won? The truth is, it wasn't real estate, and it wasn't stocks. It was consistency. Ryan didn't build wealth because he bought a rental property. He built wealth because he stayed committed through the repairs, the vacancies, and the unexpected setbacks. Alex didn't build wealth because he bought index funds. He built wealth because he kept investing through market crashes, fear, and uncertainty. Different investments, different lifestyles, but the same habit. They didn't become wealthy by making one perfect decision. They became wealthy by repeating one good decision. For 20 years. So maybe we've been asking the wrong question all along. Instead of asking, which investment makes more money? Ask yourself, which investment can I stick with, even when it gets difficult? Because the biggest mistake isn't choosing real estate, and it isn't choosing stocks. It's spending years waiting for the perfect investment, instead of letting time work in your favor. If you enjoyed this breakdown, subscribe for more videos where we follow the real math behind money. And now I want to hear from you. If you had $100,000 to invest today, would you choose real estate or stocks? Let me know in the comments. Thanks for watching. I'll see you in the next one.